compensate. The frightening thing about collapse is that it never announces itself honestly. It whispers first. Dangerous. Coffee shops remain crowded. People continue scrolling through stock prices and optimistic headlines as if the future has been guaranteed. Because human beings only fear disasters that look dramatic. But history's greatest collapses rarely begin with explosions. They begin with confidence.
It's a new economic era, my friend. Prosperity is permanent this time. You simply can't lose. Buy electro-reluctant.
Bankers celebrated in endlessly rising markets. The system appeared invincible.
How could this happen? The bank failed, it's all gone!
What are we gonna do?
Of 1929, the streets of New York still pulsed with ambition. Wall Street had convinced an entire generation that prosperity itself had become permanent. Newspapers described a new economic era where technology and modern finance had supposedly conquered instability forever. Ordinary families borrowed money to buy stocks because everyone around them seemed to be getting rich. Taxi drivers gave investment advice. Bankers celebrated endlessly rising markets. The system appeared invincible. Then, almost overnight, the illusion shattered. Men who once walked confidently through Lower Manhattan stood frozen outside the New York Stock Exchange, staring at numbers that no longer made sense. Fortunes vanished. In hours, businesses collapsed. Banks failed one after another like dominoes struck in slow motion. Families who believed they were financially secure suddenly discovered that security itself had been an illusion built on debt, speculation, and collective belief. But hidden inside the chaos was something even stranger. While millions lost everything, a tiny minority quietly became wealthier than ever before. Not years later, during the collapse itself. And this is the mystery that history keeps trying to reveal. Crises do not destroy wealth equally, they transfer it. The world teaches people to think of collapse as universal suffering. But history shows something darker. Every major crisis creates two entirely different realities existing at the same time. One reality is panic, desperation, unemployment, and financial ruin. The other is silent accumulation, assets changing, hands at catastrophic discounts, while fear blinds the majority. The same pattern emerged in Weimar Germany during the early 1920s. At first, inflation seemed manageable. Prices rose gradually. Politicians reassured the public that conditions were temporary. Life continued normally enough that most people ignored the structural danger building beneath the currency itself. Then reality accelerated. Workers demanded wages twice per day. Because prices changed by the hour, families carried wheelbarrows full of banknotes through crowded streets just to buy bread before sunset made it more expensive. Lifetime savings became almost worthless. Teachers, doctors, and ordinary workers who had spent decades building financial stability watched their wealth dissolve into paper dust. Yet even there, hidden beneath the panic, another story unfolded. Families holding gold survived differently. Owners of productive farmland retained real value while the currency collapsed around them. Those with foreign assets or hard commodities preserved purchasing power while the middle class disintegrated. Financially, the collapse looked like chaos on the surface, but underneath, wealth was moving with terrifying precision. And perhaps the most unsettling part is this: every generation believes its collapse will be different. The Romans believed their empire was eternal. Americans during the Roaring '20s believed modern finance had ended instability. Investors before the 2008 crisis believed housing prices could never fall nationally. In 2020, humanity believed technology had made civilization to advance to freeze suddenly. Then, airports emptied, supply chains fractured, markets convulsed, entire cities fell silent. And once again, fear spread faster than institutions could react, because civilization runs on confidence far more than concrete. Money itself is confidence. Banking systems are confidence. Stock markets are confidence. Governments are confidence. The modern world functions because billions of people wake up every morning believing invisible promises will still hold by tomorrow. But once trust cracks, even slightly, everything begins changing shape. That is when strange paradoxes emerge. During inflation, cash becomes dangerous. The money people spent years saving slowly loses purchasing power, while food, energy, and hard assets rise in value like lifeboats floating above floodwater. During deflationary crashes, the opposite occurs. Debt becomes suffocating while liquidity turns into survival itself. During war, borders become fragile while gold, oil, and commodities suddenly matter more than political speeches or national pride. The assets people call safe during normal times often become the most fragile during collapse, and that is because normal times distort. Human psychology, stability makes people forget that systems can fail. The Roman elite understood this deeply, as emperors quietly reduced the silver content inside Roman coins to finance military expansion. Wealthy families converted fragile currency into land, grain production, and tangible assets. They were not reacting emotionally. They were reacting structurally. They understood something ordinary citizens did not. Empires rarely collapse from one dramatic moment. They decay slowly beneath the surface, until suddenly everyone notices. At once, centuries later, the same pattern repeated during currency crises, banking panics, inflationary shocks, and market crashes across the modern world. Investors who accumulated oil reserves before energy crises multiplied fortunes while ordinary populations struggled under rising prices. Wealthy families quietly purchased distressed property during recessions, while millions panicked and sold. During financial instability, those holding productive assets often emerged stronger, precisely because others were desperate. And this raises a disturbing possibility. What if the greatest investment opportunities in history only appear when society itself begins fracturing? What if collapse is not merely destruction, but redistribution? Because every collapse creates a psychological divide between two groups of people, those reacting emotionally to fear and those preparing rationally for patterns they recognized. Long before panic began, the terrifying truth is that history does not hide these patterns from humanity. It repeats them constantly. Different countries, different currencies, different technologies, different empires, but the same emotional cycle: optimism, expansion, speculation, denial, panic, transfer. And somewhere tonight, while most people assume the modern financial system surrounding them is stable and permanent, capital is already moving quietly beneath the surface. Institutions are repositioning. Governments are adapting. Wealth is flowing toward assets designed not for prosperity, but for instability. Because the individuals who survive collapse best are rarely the smartest people in the room. They are the people who understand one ancient principle. When civilizations begin shaking, human beings always run back toward whatever feels real, and history suggests the next great transfer may already be forming invisibly beneath the surface of ordinary life, just as every previous collapse once did. Human beings suffer from a strange form of historical amnesia. Every civilization believes it has somehow escaped the ancient laws that destroyed the civilizations before it. Each era convinces itself that new technology, new institutions, new financial systems, or new political structures have permanently eliminated instability. And every time, history waits patiently before proving otherwise. Collapse is not abnormal. Collapse is one of the oldest recurring patterns in human civilization. The Roman Empire learned this slowly. At its height, Rome appeared untouchable. Roads stretched across continents, armies controlled vast territories. Trade flowed through massive cities glowing with wealth and ambition. To the average Roman citizen, the empire probably felt eternal, too organized, too powerful, to advance, to truly fail. Beneath the marble and military glory, something invisible had already begun. The currency itself was decaying. Roman emperors gradually reduced the silver content in coins to finance wars, political expansion, and state spending. At first, almost nobody noticed. Coins looked similar. Markets still functioned. Daily life continued normally enough that the illusion remained intact. But inflation behaves like termites inside wood. The structure appears stable until one day it suddenly collapses under pressure. As confidence in currency weakened, wealthy Roman families quietly adapted. They accumulated farmland, grain production, and tangible assets tied to survival itself. Meanwhile, Ordinary citizens remained dependent on a monetary system, slowly losing integrity from within. That pattern would repeat across centuries under different disguises. In 17th century Holland, tulips became speculative obsessions. Rare flower bulbs sold for absurd amounts of money, while society convinced itself prices would continue rising forever. Fortunes appeared almost overnight. Speculation became entertainment. Rationality disappeared beneath collective excitement. Then, confidence cracked, and suddenly, assets people once considered priceless became nearly worthless. What makes speculative bubbles so dangerous is not merely financial loss, it is psychological blindness. Humans become intoxicated by rising systems. The longer prices climb, the more permanent the trend appears. Eventually, people stop asking whether something has value and begin assuming value simply because everyone else believes it does. That same intoxication infected America during the Roaring '20s. Factories expanded, technology accelerated, consumer culture exploded into modern life. Radio, automobiles, and industrial production created the sensation that humanity had entered a permanent new age of prosperity. Newspapers celebrated endlessly rising stock prices as evidence of unstoppable progress. Ordinary citizens borrowed money just to participate in the market because remaining cautious suddenly felt foolish. The culture itself began worshiping optimism, and optimism can become extremely dangerous. When detached from reality, then came October 1929. The crash did not simply destroy money, it shattered psychological certainty. Banks failed across the country. Businesses collapsed. Millions lost jobs. Families who had trusted the financial system discovered that the system itself had been balancing on leverage and speculation far larger than most. People understood, but hidden beneath the suffering was another reality few people discuss openly. Certain individuals became extraordinarily wealthy during the collapse. Investors, holding liquidity, purchased distressed assets at catastrophic discounts. Productive land shifted into stronger hands. Entire industries consolidated, while fear consumed the public. The Great Depression destroyed enormous amounts of wealth, but it also transferred ownership toward those capable of surviving volatility without panic. The same invisible mechanism appeared in Weimar Germany. Hyperinflation there became so extreme that workers rushed to spend wages immediately before prices doubled again. Parents burned stacks of banknotes for warmth because the paper itself became more valuable than the currency printed on it. Middle-class savings accounts built over decades of discipline and sacrifice were erased almost entirely, yet gold holders preserved purchasing power. Owners of productive farmland retained value. Those connected to foreign currencies or hard commodities survived differently from those trapped entirely inside collapsing paper wealth. This is one of history's cruelest paradoxes. The same event that financially destroys millions can simultaneously create enormous fortunes for a prepared minority. And history repeats this paradox relentlessly. Argentina experienced repeated currency crises that devastated savers while hard assets retained relative value. During the Asian financial crisis of 1997, collapsing currencies triggered panic across entire economies. Yet foreign capital quietly absorbed distressed opportunities at massive discounts. During the 2008 global financial crisis, millions lost homes while institutional investors accumulated real estate portfolios that would later generate enormous profits. Every collapse follows its own unique storyline, but the emotional architecture underneath remains eerily familiar. First comes optimism, then leverage expands, then speculation becomes normalized, then society begins believing the current system has transcended historical risk, and finally, confidence breaks. That is why the most dangerous periods in history often feel the safest. While they are happening, the Roaring '20s felt prosperous before the Great Depression. The housing market felt unstoppable before 2008, the era of cheap money and limitless liquidity felt stable before inflation. Returned aggressively to the modern world, stability itself often plants the seeds of instability because success encourages excess. People borrow more aggressively. Institutions take larger risks. Governments expand obligations beyond sustainable limits. Financial systems become increasingly dependent on uninterrupted growth. And uninterrupted growth has never existed permanently in human history. Which brings us to another disturbing truth. During collapse, humans instinctively flee toward whatever feels real, but real, changes depending on the nature of the crisis. During inflationary collapse, hard assets dominate because currency weakens. Gold, commodities, farmland, and energy suddenly matter. More than financial abstractions, during banking crises, liquidity becomes survival because access itself becomes uncertain. During geopolitical instability, portable wealth gains enormous importance because borders and institutions become fragile in every era. Populations rediscover the same lesson. When trust disappears, perceived value changes extremely fast, and perhaps that is why collapse feels so psychologically terrifying. It forces civilizations to confront realities they spent decades ignoring. It exposes the difference between symbolic wealth and functional wealth, between paper prosperity and tangible survival. But beneath all these historical examples lies something even deeper. These collapses were not random accidents. They emerged from systems operating under invisible pressures: debt expansion, monetary manipulation, speculative psychology, political incentives, and human emotional cycles, repeating across generations, which raises an uncomfortable possibility. What if civilizations do not collapse because they fail to understand history, but because humans repeatedly behave the same way regardless of history? Modern civilization looks solid from the outside. Glass towers rise above financial districts like monuments to permanence. Digital numbers move endlessly across trading screens, worth trillions of dollars. Governments speak in confident language about growth, stability, and economic management, as though the machinery underneath society is fully understood and carefully controlled. But beneath the surface, the global economy functions less like a machine and more like a delicate psychological balancing act. Because modern financial systems are built primarily on belief, not gold, not physical reserves, not tangible wealth. Belief that currencies will retain value. Belief that debt will eventually be repaid. Belief that banks will remain solvent. Belief that governments can continue managing instability indefinitely. As long as confidence survives, the system appears indestructible. But confidence itself is invisible, and invisible structures can collapse with terrifying speed once trust begins cracking. At the center of almost every major financial collapse sits one force above all others. Debt. Debt is civilization borrowing tomorrow's prosperity to expand today's comfort. It accelerates growth, inflates asset prices, stimulates consumption, and creates the illusion of abundance long before real productivity catches up. In moderation, debt can fuel expansion. But in excess, debt behaves like gravity, pulling entire societies toward instability. At first, the process feels extraordinary. Cheap credit floods the economy. Housing prices rise. Businesses expand aggressively. Consumers purchase lifestyles far beyond immediate income. Governments finance programs and promises through borrowing instead of sacrifice. Markets climb higher because everyone believes future growth will justify present excess. The entire system begins feeding itself psychologically. Rising markets create optimism. Optimism creates borrowing. Borrowing inflates asset prices. Higher asset prices create even greater optimism, and eventually, the cycle becomes addictive. This is why financial bubbles rarely feel irrational while they are forming. Two people living inside them, rising prices, feel like proof the system is healthy. Skepticism begins appearing foolish. Caution becomes socially uncomfortable. Entire cultures slowly normalize leverage and speculation until instability itself becomes invisible. Then something shifts. Interest rates rise, liquidity tightens, growth slows, fear enters quietly. Suddenly, a system built on confidence begins discovering how fragile confidence actually is. And once trust breaks, gravity returns instantly. The housing market collapse of 2008 revealed this brutally. For years, banks issued increasingly dangerous loans because rising property values appeared endless. Financial institutions packaged debt into complex instruments sold across the global economy. Investors trusted ratings agencies, consumers trusted banks, governments trusted the market, everyone trusted everyone else, which meant the entire system depended on uninterrupted belief. The moment mortgage defaults began accelerating, that belief fractured. Banks stopped trusting other banks. Liquidity froze. Markets convulsed. Institutions once considered invincible suddenly faced collapse within days. The modern financial world discovered something terrifying. The system was not held together primarily by assets, it was held together by confidence in assets. That distinction changes everything, because once fear spreads, human behavior transforms faster than economic models can predict. Markets stop functioning rationally. Panic spreads socially. Investors sell not because assets are worthless, but because everyone fears everyone else. May panic first. Fear itself becomes contagious. And this is why the best performing investments during collapse are usually the assets least dependent on. Collective trust. Gold does not require government credibility to exist. Farmland continues producing food regardless of banking crises. Energy remains valuable because civilization cannot function without it. Water retains importance whether currencies survive or fail. These assets possess something unique during instability, intrinsic necessity. They remain useful even when systems malfunction. But collapse contains deeper paradoxes than most people realize sometimes. The strongest investment during crisis is not a hard asset at all. During deflationary crashes, liquidity itself becomes incredibly powerful. Cash gains purchasing power because collapsing markets destroy demand faster than central banks can stabilize confidence. In some crises, government bonds outperform stocks, even while governments helped create the instability in the first place. This contradiction confuses people because they expect collapse to follow simple logic. But financial crises are psychological. Events disguised as economic events, human emotion often matters more than raw mathematics. Markets are emotional amplification machines. Fear accelerates decline faster than fundamentals alone ever could. Once panic begins, crowds behave almost identically across centuries, regardless of culture or technology. First comes denial. People insist conditions are temporary. Experts appear on television, reassuring the public that fundamentals remain strong. Governments promise stability. Markets experience temporary recoveries that create false hope. Then comes panic. Investors rush toward exits simultaneously. Liquidity disappears. Institutions become defensive. People begin selling whatever they can rather than what they should. Emotional survival overrides strategic thinking. Then comes blame. Politicians accuse corporations. Corporations accuse regulators. Citizens accuse governments. Entire societies search desperately for villains, because accepting structural fragility feels psychologically unbearable. And finally comes consolidation. This is the phase most people never fully notice. During the Great Depression, productive land and businesses shifted into stronger hands, while ordinary families struggled merely to survive. During 2008, institutional investors quietly accumulated distressed real estate while millions lost homes. During inflationary crises, owners of hard assets often emerge stronger, while wage earners slowly lose purchasing power. Collapse does not simply destroy wealth. It reorganizes ownership and the individuals who benefit. Most are usually those capable of remaining emotionally detached, while everyone else reacts impulsively. That is why crises reward patience so disproportionately. Fear narrows human perception. People trapped in panic stop thinking strategically about years and begin thinking biologically about days. Immediate survival becomes the priority. Meanwhile, disciplined capital waits, and perhaps that is the darkest realization hidden inside financial history. The system may not truly be designed for permanent stability. It may be structurally dependent. On periodic resets, debt expands until repayment becomes mathematically impossible. Speculation inflates until confidence fractures. Weak ownership structures collapse. Assets consolidate into stronger hands. Then the system rebuilds beneath new narratives, new technologies, and new promises. Civilization presents collapse as malfunction. But structurally, collapse often behaves more like release, like pressure escaping from deep beneath the earth before. Tectonic plates rupture completely, and this becomes infinitely more dangerous in a globally interconnected world, because modern economies no longer fail in isolation. Banks are connected across continents. Supply chains stretch across oceans. Currencies influence one another instantly. Algorithms react to fear within milliseconds. A housing crisis in one country can destabilize markets on the other side of the planet before sunrise. The dominoes are now connected by invisible wires. And when one begins falling, the entire structure starts trembling.